My name is Allie Piro, and I'd like to thank you for watching our report covering Teche Holding Company. The other analysts on our team are Sean Dwyer, Ryan Herzich, Dylan LaCorn, and Lindsay Wood. Teche Holding Company is the parent company of Teche Federal Savings Bank. The bank holding company is based in New Iberia, Louisiana, and is engaged in retail and commercial banking throughout southwest Louisiana. The company's key products include checking and other insured deposit products, as well as commercial and consumer loans. Teche recently converted from a federal bank to a Louisiana state bank to take advantage of the opportunity to operate under local regulation. Local regulators have a strong understanding of the community banking business strategy, consumers, and the region that community banks serve. Trading on the Amex, Teche's ticker symbol is TSH. As of November 18th, the company is trading at a price of $33.32, with roughly 2.06 million shares outstanding and a market cap of $71.93 million. A high insider ownership level of 35% effectively aligns management interests with shareholder interests. Based upon our valuation, we've given Teche a 12-month target price of $38. Dylan will discuss the valuation methods used later in the presentation. Here we have a graph of Teche's performance on the Amex over the past year. This price graph illustrates a 52-week range of $28.30 to $37.32 and a closing price of $33.32 on November 18, 2011. Teche initially issued 4.2 million shares when it went public in 1994. Since then, it has reacquired roughly half of that amount through consistent buyback programs. Specifically, Teche management has bought back 8,724 shares since April 2011, and a decline in the Teche stock price has management considering repurchasing additional shares. Here, in the upper left-hand corner, we have a map showing the location of Teche's 19 branches within Louisiana. The state's healthy economy, composed of the oil and gas, education and healthcare, petrochemical, shipping and trade, agriculture, movie, and hospitality and leisure industries, has provided the company with a solid foundation for future growth. Additionally, holding comparatively less bad debt and a lower unemployment rate than Alabama, Arkansas, Mississippi, Texas, and other states similar in size has helped shield Teche from the worst effects of the economic downturn. Since 2001, Teche's smart growth strategy has provided a boost to the company's net interest margin while helping manage interest rate risk. This strategy involves restructuring the company's loan portfolio from conforming mortgage loans to higher-yielding commercial and retail loans, with a focus on using lower-cost deposits to fund higher-yielding loans. Smart growth focuses on the origination of high-quality, high-yield, and short-term loans and helps Teche continue to diversify its mix of loans and deposits. Smart growth loans make up 78% of Teche's loan portfolio. Focusing on long-term growth of the right kind of loans has also allowed Teche to maintain its commitment to strong asset quality and to position itself for success. Teche has returned capital to its investors since 2002 through a strong dividend payout. The company is currently paying out over 41% of its earnings through dividends, and its yield of 4.5% is much higher than the industry average of 2.4%. This high and consistently growing dividend indicates that Teche can generate revenue and pay its shareholders. These signs of strength and the company's ability to retain enough income to sustain itself over both the short and long term should attract income-oriented investors.
Dylan here to talk to you about valuation methods and other financials. We determined our 12-month target price of $38 by taking the weighted average of two separate valuation methods, the price-to-book value method and the dividend discount model. The price-to-book value method is the most reliable method of valuation for a financial institution because it accurately represents the nature of the banking business. The constant valuation of assets and liabilities to market, as well as the frequently changing debt and cash levels of a financial institution, are well represented by this method. The second method we analyzed was the dividend discount model. The dividend discount model is an income approach model that determines the price an investor would pay for a stream of future cash flows. This model fits well with Teche's consistently growing dividend payout. Increasing its dividend at a steady rate each year since 2003 has provided Teche with an additional competitive advantage, making the company attractive to investors. It is also important to note that our model and projections are primarily based off assumptions about the future of the Louisiana economy and Teche's ability to increase lending activities. The economy expands and contracts over time, and construction and manufacturing levels, foreclosure rates, and inflation levels change with the economy during these times. This cyclicality affects consumer habits, including their choice to spend or save money. Loans made and deposits received are largely determined by the spending habits of Teche's customers and drive a large portion of Teche's revenue. The business Teche does with its customers is therefore heavily affected by the cyclicality of the economy and the subsequent spending decisions of the company's customers. We predicted that the economic health of Louisiana will continue to improve, and that Teche will be more aggressive with its lending tendencies. These two factors will allow Teche to consistently grow in the foreseeable future. Teche's strong financial condition and assets of nearly $800 million have positioned the company for future growth. Teche was able to maintain financial stability and generate excellent results without accepting TARP funds during the financial crisis of 2008. Throughout this crisis and during the 2009 and 2010 fiscal years, Teche was able to change its mix of its loan portfolio while holding its assets relatively steady. The strategic decision not to grow its assets, paired with a limited reliance on risky loans and a low number of non-performing loans, has helped Teche stand out among its peers. High-quality loan underwriting has enabled Teche to boost its net interest margin and maintain profit growth. As of November 18th of 2011, Teche's return on average assets stands at 0.93% compared to the industry average of 0.62%. Since 2008, this return on average assets has increased year after year. Additionally, Teche posted record earnings per share for the 3 consecutive years 2009, 2010, and 2011, despite the difficult economic environment. Teche's low price-to-earning ratio of 9.66, coupled with the earnings per share growth and a strong dividend payout ratio, confirm that the company can generate revenue, perform well, and return value to its shareholders. This wraps up our presentation of Teche Holding Company. Our analyst team sees great potential in Teche and feels it's worth a closer look. Thanks so much for being with us today. The Burkenroad reports are produced solely as a part of an educational program at Tulane University's A.B. Freeman School of Business. The reports are not investment advice. You should not rely on them in making any investment decisions. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.